Hey, welcome to Swifty Invest. My name's Lugo. So today I want to tell you guys the top stocks that I'm looking at during this whole AI bubble situation we're in. So they're saying we're in an AI bubble. You know, me, I really just try to keep it simple. I just pay attention to the stocks that are outperforming and that basically show a lot of growth and potential to grow from where they are. Because if they're able to do that, I'm able to make a profit, buying it when it's sitting where I feel like it's undervalued. So one of the stocks that I feel like is going to run up um, is going to be Lyft, and I have it pulled up here as you can see, right? So with this company, right, I feel like they're one of the ones that are overlooked. So a lot of people talk about Uber, they talk about Waymo, robo taxis, and everything, but people forget that Lyft owns about 20% or so of the market. Uber owns about 70, and then the other little ones you have robo taxis and Waymo, and I do say little not as a thing because these companies are actually growing, like Google with Waymo, the robo taxis, they're actually growing, but it's just they're going through a phase of filtering. Like they have to make sure their cars are safe and they have to get approval before those cars can get on the road. So the whole goal is to make sure that, whatever investment you have, that you want to know that do they have enough moat to be able to withstand, you know, um, competition. So I feel like the space right now is mainly a duopoly. It's Uber and Lyft. Those are probably the two biggest, ride hailing in the U.S. So the way I look at it is like right now, Lyft, they went through a management change, a new CEO. He's focused on growing the company, and his interest is actually aligned with shareholders and for him to grow the company, and he's been doing great. He's been coming out with new features, doing a lot of partnership. So all these is what's been kind of stimulating the growth of Lyft. And one thing people should keep in mind is that Lyft doesn't have a food delivery, compared to Uber, which has Uber Eats, which you deliver food, but Lyft doesn't have that. And according to the delivery business, it's actually a growing segment, and there's a lot of growth in that department. That's why you see the likes of DoorDash and Uber Eats. They make a lot of money through there. It's more higher margin compared to like the basic, you know, passenger driver, you know, taxi service. So I feel like if Lyft does enter that segment, the minute the CEO says, "Hey, we're gonna start delivering food," you're gonna see the price just re-rate itself. I would not be surprised if it did, because people know that that's more profitable and more, there's more margins in that compared to like paying the driver and going through all that other stuff. So that's one reason why I feel like Lyft could easily have a catalyst in that department. But even without that, they've been doing pretty good and growing, So that's the reason why I'm actually invested in it. And I feel like if the price was to double, let's say it went to like 30, 35, 40 or something, 45, I would start kind of like taking off some of my positions because I'm really in this just for the swing because I'm looking at the valuation. It's at 7.9 billion, right? But people don't realize that Lyft, right? They generate about let's just say 1 billion in free cash flow. So they look at the cash from operations as 1.1 billion, right? Their free cash flow they generate is about a billion on a trailing 12 months. So if a company's generating about a billion, right? And is and the valuation is at 7.9 billion. What that tells me is like it's undervalued only if it's growing. And let's see if it's growing, right? That it's growing at like 15%. So when you look at that, I'm just like, it's too easy. I don't want to say it's too easy, but you know what I mean? It's just, to me, it's just a screaming buy for me. I don't know what it is, but everything looks, I was just driving the other day. I seen like four lifts go by me, and I like to pay attention to the passenger seat to see if there's people actually in the car, and there was. I think three out of four of them there was somebody in the car. The other one, was empty. I don't know if they're picking someone up or what, but I like to see that because, I mean, at least in my area, I'm like, I see Lyft all the time. I take Lyft, so it's like, you know, but yeah, man, and look at the free cash flow is 16%, so above 15. That's pretty profitable to me if you should tell me so. Yeah, so the gross margins is actually similar to Uber. It's 35%, which isn't too bad. They're growing. They're growing, and that's what I like to see. Free cash flow is increasing 60%. Gross margins, gross profit is increasing 21%. Operating cash flow is increasing 45%. Operating income increasing 112%, which is great. So that's the thing. A lot of, I was able to buy this company, like, see, I was accumulating them even when they were trading as low as almost $9, right? I bought it all the way up to like even where it's at, so I just been accumulating because I just felt like it's just cheap. You know what I mean? So when I say something's cheap, it's not just because obviously because they make $1 billion in cash, and I also want to see growth. So if I see growth, I'm like, this company's being ignored. So that's why I feel like it's gonna definitely grow. Without a doubt, it should grow. I don't see why they wouldn't. You know, so yeah. So price to free cash flow 7.68. That means the amount of free cash flow they get, right? They could, and let's say they did not grow, right? They just got the same amount of free cash flow with the same, they could make all that money back of what the company's worth, 7.9 billion in 7.6 years. If that makes sense. So that's where I'm just like, yeah, that doesn't. So if you want to see how many percent that is on an annual basis, all you have to do is just basically divide that. Let me do that on my phone real quick. So you do 100 divided by 7.6. That would give you about 13.15% annualized, which isn't bad. So that's like if they weren't growing. But keep in mind, they're growing about 15%. You know what I mean? Look at that. They're growing about 15%. No brainer. So, anyways, I'm going to leave it at that. We're going to move on to the next one. Hims. All right. This is another company I like. I've owned Hims since it was in the single digits, low single digits. I started buying it. I bought my first share like 2021, because I believe in the company. It's in the healthcare sector. I work in the healthcare field, so I know a lot, when it comes to like healthcare and certain things. So a lot of things I see this business doing, I see it as it's going to disrupt the legacy of healthcare we have now, the old fashioned way. Nowadays, plain and simple, like you have a situation, condition, right? You could literally, if it's something that doesn't require you going to emergency room and all that other stuff, if it's a certain thing, you could literally discreetly talk to a doctor, get, you know, get care provided to you without you even leaving your house, and then get everything delivered to you and just have your treatment delivered to you. And you just take care of yourself and that's it. And then you could follow up with the doctor, everything without you actually moving an inch. So to me, I'm big on convenience. So when I see that convenience, I'm like, this is good. Like I don't see people doing what they're doing. So I'm like, I like that. But I do start to see a lot of companies doing it. But if you look deep into the company, the way they're doing it and how they're doing it, they're like the biggest winner to me because they're expanding and they're doing more. They're creating more. There's a lot of things they're attacking, and I like that. So that's one thing I'm bullish with them. So when I look at them, also what makes them attractive is also their treatment options. So if you're in the healthcare field, right, when it comes to business, like you're dealing with people with chronic issues, right? So if you have a chronic issue, right, you don't just have one issue. There's also multiple issues and certain other things that cause that chronic issue. So what they do is they compound a treatment. They can compound a treatment that treats all your chronic issues at once, rather than you go to a doctor and you go and they're like, oh, okay, I'm going to give you this for your pain, and I'm going to give you this to take care of that, because when you take that pain, you're going to be constipated, so you're going to need this. I'm going to give you this. So you're like, what the, so at some point you just have a whole bunch of supplies on there. But when it comes to Hims, they try to keep it as simple as possible while being effective in taking care of whatever situation, chronic issues you have. And, to me, I like that. Um, Proposition, and that's one of the reasons what got me attracted to the company. And if we want to look at their financials, it's a $7.9 billion company. So it was trading, it fell over 50%, right? I think, yeah, it fell over 50%. So like it went as high as 70. No, I'm sorry. It went as high as almost 65 or so, whatever. Now it fell as low as like 32, 33. So it's at a point where it's attractive to buy. I already have a decent side position. I am adding a little bit to it. I did buy some the other day. This is, to me, I just feel like it's just a screaming buy, because to me, right now, I feel like the companies could easily be valued at like $65. You know what I'm saying? So if it's trading almost half, I'm getting almost a 50% discount. So I'm like, hey, mine as well, man. If you're gonna give me 50% off, this stock, I'll buy it any day. So I just like, let me just buy it. A lot of people tend to, because they bought like in the single digits or whatever, they try to not. It just doesn't make any sense to me. I feel like if you see this company being, let's say, X amount of, 5, 10 years from now, you see this company being a $500 company. Does it make any difference if you bought it at 7 or if you bought it at 35 or what? It doesn't really matter. So, at the end of the day, you're going to make a lot of profit along the line just by buying at this level. So to me, that's the way I look at it. Honestly, the only downside with this company, I would say, is the dilution. So I want to map that out because a lot of people overlook that, but they tend to dilute. You can see the share count, you see going up a little bit over time. It's not as bad compared to like other companies, but I just don't like dilution. They dilute an average, what you see, it says here is diluting about 5%. So I don't really like that. I'm not really a big fan of it, but I do understand it's a fairly, it's a company that IPO'd about 4 or 5 years ago. So it's like acquiring talent. So I know this stuff because I've been following the company. So if you follow the company, you know all this. So they've been acquiring people. So they're acquiring them through giving out shares, and you know what I'm saying. So share compensation, and that's why this kind of percentage of dilution is kind of like at 5%. You know, but it is what it is. They are executing and doing well. It's just something I like to keep an eye on. But other than that, the gross margin is 75 again because the company is simple. Everything's dealt with online. It's like e-commerce for medication. You know what I mean? So they cut off all that fat, all that asset like buildings and offices and all that stuff. There's no need. So it's capital light, not capital intensive. That's why they're able to have these nice gross margins of 75. At a point, it was at 80%, but now they're reinvesting a lot of things going on. So it's hitting their margins, you know. Um, it's still an early company, so I don't pay attention to the free cash flow margins, operating margins, but I do pay attention to see if it's trending the right way, which it is. Revenue is growing at 78%, so company growing 78%, diluting about 5%. I kind of, I keep it there, but I'm like, I'll let y'all, I'll let them keep cooking, you know what I'm saying? I look at net income and I'm seeing how it's growing over time, and I like that. The 194 million, it did fall back down because they're reinvesting. So this time, the earnings did fall back down, which is understandable. They're growing, so I'm not looking to make a profit today or something. This is a company you got to hold and watch it compound over time. So they're just compounding over time. So that's the reason why I like them. The cash from operations is growing the right way. I love that. It's a great business. So anyways, man, enough about that. The reason why I'm focused on this is because I see an opportunity when it falls like this. When you give me a 50% discount, I'm shooting. I'm taking my shot. The last company that I'm interested in, it hasn't gotten to my price target where I want to grab it, but where I do want to grab it at is at like around $75. So right now it's at 108. So it's Robinhood. I'm looking at them and I'm interested because I see the growth they're growing. I'm looking at the net income; it's just growing over time. Right now, I mean, last year they had about 1.4 billion in net income. And they were trading way lower than this. So the fact they were growing, they're growing their earnings like, it's in the financial sector, and I see They're growing a lot. They opened the predictions market. They have a Roth IRA. You could do direct deposits with their app. You can, I think now you can take out a loan. I mean, they've been doing it for a while. You can take out a loan on Robinhood now. You don't have to go to the bank, the typical old fashioned way. Remember, you used to you had to print out all your documents, everything, take it to the bank. Sometimes you go there, you talk, wait in line, talk to somebody. They might even reject you and tell you to come back with more documents. See, you got to go through all that when now you have Robinhood, where you could just literally on your phone, like literally just straight up, da, 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 and just get approved, and the loan's there. You take it out, so withdraw it, And I believe they have better rates compared to like other, banks, when it comes to their marketplace. Meaning like if you deposit cash, the interest you get on that cash, they have pretty good rates compared to banks, obviously, because most banks don't even give you good rates. And they have good rates also, obviously, if you take out a loan against your asset or whatever you have, they give you better loan term compared to like a bank, you know. And the reason why I feel like banks do that because, they have buildings they have to pay rent for, they have employees and all that. But when you have a app based, it makes things a little less light, more capital, less capital intensive. Therefore, as a consumer, we get to enjoy, if that makes sense. So that's why I'm invested in Robinhood, and I like what they're doing. And another reason why I do like Robinhood and I do see future more growth is because if you pay attention, right, they've been having a lot of assets inflow coming in. And I feel like that's going to continue happening because a lot of people using their app are actually Gen Zs and millennials. So whether the younger generations. So they're more inclined with the younger generations. So when you're more inclined with younger generations, right, over time, the baby boomers, Gen X's, all those, right, you know, that are passing on their wealth, right, to their younger ones, the other generation, which is millennials and Gen Zs, they're going to be the recipients of that. And let me ask you, where do you think they're going to put that? Where do you think it's going to go? And they're already investing in the market. So where do you think they're going to put it? So yeah, so that's why I feel like they're going to have more inflows, and it's just going to continue that way. So I feel like it's a great company, to hold for the long term. So that's why I feel like this isn't a company buy today, tomorrow it's gonna. No, there's a company I'm feeling like you should average in over time as it drops. So right now, I did say it's at 108, but it dropped from like in the 150s. So I see a double top here. So that's a sign of weakness in the stock price. So it is coming back down. If it could come down to, I want to say 75, 70s, 80s, I would definitely start adding a pretty decent size, right? Because that's kind of where I would like it to come down to. I'd be more attracted to it because this is a company that's growing. It's growing 74%. Their revenues are growing 74%. Cash flow margin is high at almost, what is it, 26%? Come on. Can't beat that. You know what I'm saying? Return on invested capital is around that 20% mark, which is great. Return on equity, this is what you should be measuring them by, is 25%, which is beautiful, So, because they're in the financial sector, they're like banks. This is basically like a good return on equity, you know. The gross margin's high, of course. Operating margin is good. Free cash flow margin is good. Cash conversions at 51%, which is great. Net margins, beautiful. And so I want to see how they're growing their operating income. They're growing at 281%, which is spectacular. So I like using this app because it kind of does everything for you, calculates everything on the transfer mode. This is Stock Unlock. I'm not endorsed by this company. I just use it. It's easier rather than me calculating it. But, you see where I'm going with it. But yeah, man. So if I'm seeing this, right, and I'm seeing the net income, right, rising, the way it's rising like this is what you call is what I call Robinhood a super bank. They're on their way to be a super bank, and I like them. I like what they do. They're not just making money, but they're making money while they're helping regular retail. You know what I'm saying? investors and anybody. So they're making things more convenient. The CEO is doing a great job doing that, and he's very focused on trying to make Robinhood the one-stop shop, basically, right? But yeah, I'm gonna keep it simple here. That's basically it. Those are the three companies, I'm very interested in, and that's Lyft, Robinhood, and Hims. All right, those are like the three powerhouses to look at for the next, I want to say, 5 to 10 years. Those are the three powerhouses, except excluding Lyft, because Lyft is they have a lot of competition that might come. So I don't know how the robo taxi is gonna be with them. So that's why I said I would definitely cut down a little bit of my position if it doubles, right? So with this whole bubble thing going on, I think like it's creating opportunity in the market. So these are the three stocks I would say pay attention to. And again, I'm not a financial advisor. I'm just here to show you what I'm doing. These are things kind of just keep on your watch list. If you like this video, please like, subscribe. And if you want to also get more details and all this stuff, you could also join our community, Swift Trades. That's a community where I pretty much kind of go more in depth. But other than that, I'll be pumping out stops content here so you guys to enjoy. All right. Peace.